If you had invested 1 lakh rupees in Reliance Industries on June 1st, 2009 and held the stock until December 30, 2016, can you guess how much returns would have made? Well, your 1 lakh would have turned into 95,000 as during this period, the Reliance Industries stock returned negative 0.69% per annum. Of course, you would have earned dividends too. So you could have come out even. So you didn't lose anything, right? Well, during this period, the Nifty 50 climbed by 8.11% per annum. So, if you had invested in the Nifty instead of Reliance, your 1 lakh would have turned into 1.81 lakh, making you richer by 81,000 rupees. Forget about the Nifty 50. If you had just left the money in a savings bank account, you would have earned about 30,000 in interest pre-tax. In a 6% FD, the sum would have been close to about 56,000 pre-tax. Would you still say you didn't lose anything by investing in Reliance? Hello and welcome to ET Money's YouTube channel. What we discussed just now is a phenomena called as time correction. Now, time correction is a silent killer that can significantly affect your returns, and the funny part is that you may not even realize it.
You don't realize it because on a day-to-day basis you experience the usual volatility. It's only over a period of time that time correction shows its impact.
In today's video, we will discuss this phenomenon in detail and try to answer how it can be avoided. Now, this video belongs to our playlist on market trends. To watch more such videos, do explore it. The link is in the description. Okay, let's start. When we talk about correction, we generally mean just one type, price correction. And we are witnessing a price correction these days. Since September 26, 2004, the Sensex has dipped by about 13.5% from about 85,800 to 74,200. Now, if you had invested 1 lakh in Sensex on September 26, 2024, your corpus would have been about 86,500 as of April 8, 2025. Now, that's a visible loss of capital. But the movement of Sensex between October 2021 and March 2023 exemplifies time correction. During this period, the Sensex returned a negative 0.6% per annum. That's almost flat. So on the face of it, you didn't lose any money. Yet, if you keep money in a savings bank account during this period, you would have done better. So while price correction is an explicit loss of capital, time correction is an implicit one.
Do note that the Sensex did fluctuate normally on a day-to-day basis. It's only when you see over the period that it didn't go anywhere.
Now, time correction can be seen as an opportunity cost, where you lose because you are not invested in another asset that is doing well. Now, there may not be a visible loss of capital, but the loss arises from the fact that the asset hasn't gone anywhere during a certain time period. Now, in market lingo, this is called a sideways or a range-bound movement of asset prices. Now, according to a concept of time value of money, the money received today is more valuable than the same amount received at a future date. That's because the money that you receive today can go on to earn some returns. Not only that, the money you receive at a future date also has a less buying power due to the effect of inflation. When an asset undergoes time correction, it generates little or no returns, and you lose money not just because of the opportunity cost, but also due to inflation. Now, if you factor in an inflation rate of 6%, 1 lakh today is worth about 73,400 5 years from now. This makes time correction a serious drag on returns. Now, as we discussed, you may not even realize it and continue to hold the asset, hoping it will do well at some point in time. Okay, so far we've considered examples of just equity to illustrate time correction. But it's not that time correction plagues just equity. It can affect any asset class. Let's see that in the next section. No asset class is immune to time correction. Consider silver. Silver was quite range bound between 2017 and 2020. So it suffered time correction during this period. Gold didn't move much between November 2013 and March 2019, thus suffering time correction. Now, while real estate market is not as transparent as day-to-day pricing is concerned, it also undergoes periods of stagnation where the prices seem to be going nowhere. For instance, during the COVID period, the housing market entered a phase of time correction. It took 2 years for housing prices to firm up as disclosed by the Economic Survey of 2023. Now, a good question to ask is if debt also undergoes time correction. After all, if the interest rates on debt are fixed, Can it undergo time correction? Well, the answer would depend on what kind of debt you are talking about. If you're talking about bank FDs and other fixed income avenues such as the PPF or Senior Citizen Savings Scheme or the Sukanya Samriddhi Yojana, then yes, you will continue to get your interest payout and the concept of time correction may not be applicable in nominal terms. But in real terms, if you adjust the returns by the inflation rate, even fixed income can suffer time correction. For instance, if the PPF rate is 7.1% and the inflation rate is 6%, you effectively just earn 1%. At this rate, the real value of 1 lakh rupee invested 15 years ago is just 1.18 lakh and not 2.8 lakh, which is the nominal value. Now you can always argue that the effect of inflation is applicable to all asset classes, not just debt. And that's right. In essence, any asset that doesn't beat the rate of inflation over a period is undergoing time correction, even if its nominal returns are positive. So debt is especially prone to this rather insidious time correction given its usually low to moderate return profile. Now another side of debt investments is market-linked debt, such as debt mutual funds and bonds. For market-linked debt, while the interest rates for the underlying bonds are fixed, the prices of such bonds can fluctuate depending on their credit profile and interest rate sensitivity. For instance, consider the annual returns of long duration debt funds for the last few years. The category can be said to have suffered time correction in 2021 and 2022 with its returns ranging from 1% to less than 2%. Even categories that hold comparatively short duration bonds can also undergo time correction, albeit for shorter periods. For instance, short duration debt funds have exhibited a median minimum return of -2% for a 1-month investment period. This minimum kept going up as the holding periods increased, with the median minimum turning positive for a 6-month holding period. Now these examples suggest that debt can also undergo time correction. Now the next obvious question is why time correction happens. Let's see in the next section. But before that, if you aren't already a subscriber, do subscribe to the channel and do press the bell icon so you never miss a video from us. To understand the reasons for the time correction in an asset class, we need to check the fundamentals of the asset class. For instance, consider Reliance Industries, which we discussed at the start of the video. We observed that the Reliance stock hardly moved between June 2009 and December 2016. Now, this could be attributed to company's sluggish profit growth during the period. Over these 6 years, the company's profit grew at 3.4% per annum. Next comes silver, which as we saw had been range bound between 2017 and 2020. Let's check silver's supply demand data to understand the reason for this. Now, silver's demand originates from industry usage, photography, jewelry, silverware as an investment. Its supply comes from mining and recycling. Between 2017 and 2020, the supply was enough to absorb the demand. However, as demand outstripped supply after 2020, silver prices surged. Now, gold moved sideways between 2013 and 2019 as we discussed. Let's also check gold supply and demand data. Gold demand originates from jewelry, technological manufacturing, investments as a reserve for central banks. Its supply comes from mining and recycling. Between 2013 and 2019, gold supply was adequate to absorb gold demand. That may have been the reason why gold didn't move much. Property prices remained suppressed during COVID-19 period as the world moved indoors and the economic activity reduced. But what about debt funds? Well, debt funds returns tend to be impacted by interest rate movements, or rather the expectation of interest rate movements. If interest rates are expected to go up, the prices of existing bonds fall as they become less attractive and vice versa. Now, this movement is more pronounced in the case of long duration bonds and hence debt funds that hold such bonds. The expectation of a rise in interest rates possibly resulted in subdued returns by long duration debt funds in 2021 and 2022. Now, as far as equity markets are concerned, they can remain range bound if the valuations are pricey, but the growth prospects look bright. So, for one reason for the standstill markets between October 2021 and March 2023 could be high valuations with respect to long-term median. Now, during this time, the economy had recovered smartly from the COVID-19 shock, and the release of pent-up demand kept growth expectations high. Now, the bottom line is that if an asset is undergoing time correction, there is often a reason behind it. Of course, the reason may not always be asset specific. There could be economic or geopolitical factors as well that make an asset time correct. So given all this, the million-dollar question now is, how can you avoid time correction? Let's try answering this in the concluding section of this video. One can argue that time correction is unavoidable, as you get to know only in hindsight where an asset has undergone time correction. Now that's right to a great extent. One can also argue that one need not worry too much about it, as eventually all assets recover from time correction. All the assets discussed in this video have overcome time correction, be it the Reliance stock or the Sensex or silver or gold or debt funds. So that's also right to a great extent. So of course, the obvious solution to time correction appears to be doing nothing. If you just follow your asset allocation and rebalancing portfolio, you should do just fine. Indeed, for vast majority of investors, this can be an optimal solution. Yet, given the opportunity cost afflicted by time correction, can one do something about it? Well, the answer is yes. Welcome to the world of dynamic asset allocation. As against static asset allocation, where you maintain your exposure to various asset classes in a fixed ratio, dynamic asset allocation seeks to double down on assets that have positive tailwinds and reduce exposure to those that may be ripe for correction, whether time correction or price correction. Now, to practice dynamic asset allocation, you need to be always looking at the fundamentals of various asset classes and adjust your asset allocation accordingly. If done correctly, dynamic asset allocation can reduce the impact of time correction on your portfolio returns to a great extent. Now, one way to practice dynamic asset allocation is to do it manually based on your own judgment. Sure, that will require a higher degree of sophistication and commitment in terms of time and effort. But if you're looking for a hands-off solution to do this, within mutual funds you can explore dynamic asset allocation and multi-asset allocation funds. And you can find smart solution to do this on the ET Money app. So do explore it. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.